Welcome back. Time for us to see the impact of our adjustments by reviewing the adjusted trial balance. Then we will learn how to prepare another type of journal entry called a closing entry. But first, a quick refresher. Can you answer the following questions? You should be able to based on your studies so far this chapter. Take a look. I recommend pausing the presentation for this slide and the next and trying to work through the answers. Okay then, the adjusted trial balance. Once we record the adjusting journal entries in the general journal, we post them to the general ledger. Next, we will prepare an adjusted trial balance. This slide illustrates the adjusted trial balance using a tool called a worksheet. We will not be learning to prepare a worksheet in this chapter, although sometimes accountants use worksheet to decide what adjustments need to be made. The main purpose for showing you this worksheet is so you can clearly see how the adjusting journal entries change unadjusted account balances. In an unadjusted trial balance, those are the two columns to the left with numbers in them. It's a list of accounts and balances that were prepared before adjustments were recorded. And an adjusted trial balance, those are the two columns on the right, is a list of accounts and balances prepared after adjusting entries have been recorded and posted to the general ledger. The adjusted trial balance is the cleaned up version used to prepare the financial statements. So here we show both the unadjusted and the adjusted trial balance, as well as the adjustments that were made during the period. The order of accounts in the trial balance is usually set up to match the order in the chart of accounts. Most computer systems do this for you anyway. Several new accounts arise from adjusting journal entries, and each adjustment, see the middle columns here, is identified by a letter in parentheses that links it to an adjusting entry. And each amount over on the right-hand side in the adjusted trial balance columns is computed by taking that account's amount from the unadjusted trial balance columns and adding or subtracting any adjustments. All this stuff would happen within the general ledger. We would move from unadjusted to adjusted balances. So as I mentioned previously, the trial balance then can be evaluated to note what there is that needs to be cleaned up with respect to the deferral adjustments. And for the accrual adjustments, some hints can be found by looking at the trial balance as well. We might also have to look at the unpaid and unrecorded bills sitting over in the mail pile and talk to the service providers in our company about work that has been performed but unbilled. Now, the worksheet mechanics itself are covered in Appendix 3B if you'd like to have a look. You will prepare a worksheet as part of the comprehensive problem when we get to Chapter 9, so please make a note now about that so you know where to find the information. Okay, so next we will see how to prepare financial statements using the adjusted trial balance. We can prepare financial statements directly from information in the adjusted trial balance. An adjusted trial balance includes all accounts and balances appearing in the financial statements, and it's easier to work from than the entire ledger when preparing financial statements. Take it from me personally. So since accounts on the trial balance are listed in financial statement order, assets first, followed by liabilities, then equity and revenues and expenses, it's pretty simple to prepare financials. First, you prepare the income statement looking at the trial balance and just using the revenue and expense accounts. Second, we prepare the statement of retained earnings. And this statement updates the retained earnings balance from the adjusted trial balance again. Notice the balance of retained earnings in the adjusted trial balance is from the beginning of the period and is 0. You can see also net income flowing into the statement of retained earnings from the income statement, and dividends flowing into the statement of retained earnings from the adjusted trial balance. And finally, we will prepare the balance sheet using both the adjusted trial balance and the statement of retained earnings. And here it's mistakenly referred to as a statement of owner's equity. It is a statement of retained earnings. And finally, I guess, the important point, you should know this by now, the balance sheet must balance. Total assets must equal total liabilities and equity. We are now then getting ready to finish off the accounting cycle with a review of the annual closing process. So once formal financial statements have been prepared, we may begin the process of closing the books and getting ready for the next accounting period, like the next year. Remember how early on in the course we talked about accounting being about keeping track of the score of a game? Well, we don't want the game to go on forever. We want to finish and start a fresh new game. And to start a new scoreboard in accounting, we need to define which accounts are scoreboard accounts that need to be wiped out, zeroed out, and start again the following game at 0. These are the income statement accounts, or what we call the temporary accounts. Revenues and expenses and the dividend account from the retained earnings statements are all temporary accounts. They're all zeroed out. Now, the permanent accounts are those from the balance sheet: assets, liabilities, and stockholders' equity. These accounts are permanent in nature because their balances are carried forward from one accounting period to the next. To help all of this make sense, go back to home base, our good friend cash. Now, if my accountant is trying to wipe out my cash account to a 0 balance just to start a new year, that is not going to be okay with me. It's not going to go well at all. I do insist on starting the new year with the cash I ended the prior year with. Don't mess with my wallet. Therefore, the balance of the cash account is considered to be permanent, and all the asset, liabilities, and capital accounts, that would be common stock and retained earning accounts, are permanent accounts. Another way to keep this idea in long-term memory is that our personal life as an employee, our employer keeps track of how much in wages we have been paid over the course of the year. We then report the wages we earned over the calendar year to the Internal Revenue Service and pay taxes on it. And personally, I'm always perfectly happy with my employer when we start the new year with 0 wages, because I've already paid taxes on the prior year wages, and I don't want to pay taxes on my wages more than once. Therefore, the revenue coming into my personal financial statement is a temporary account. I want it to revert back to 0 to start the next calendar year. The closing process's goal then is to reset all revenue, expense, and dividend accounts to 0 at the end of the accounting period. We will use a temporary account called the income summary to facilitate the closing process, and this account will never ever appear on any financial statement and will have a 0 balance once the closing process is complete. Here I have broken a trial balance into 2 parts so you can clearly see which accounts are temporary and you can see which accounts are permanent accounts. The temporary accounts are at the bottom of the trial balance. They start with dividends and run through utilities expense. The permanent accounts are the balance sheet accounts. They start with cash and go through retained earnings. Here then are the 4 steps we always follow in the closing process. I suggest you memorize them. I remember these steps by using the acronym REID, R-E-I-D, for revenues, expenses, income summary, and dividends. The entries actually start with revenues and expenses on the income statement, then move to the income summary account, and finally pick up dividends. The ultimate result after completing these 4 entries is that they close all temporary accounts to one permanent account called retained earnings. So the closing process results in retained earnings being updated to reflect the activity and ending balances that are shown on the statement of retained earnings. It's pretty cool. And finally, please don't forget that all journal entries, regular, adjusting, or closing, must be posted to the general ledger for the accounting records to be correct. This is a very common mistake for students to make. However, the accounting records aren't correct if you don't post closing entries to the general ledger. So just picture the general ledger as the scoreboard we've been talking about, where all temporary accounts are zeroed out so the company can start a brand new game of business next year. Let's look at the actual closing journal entries. Here are the 4 steps we always follow in the closing process. Journal entry 1. Close credit balances in the revenue accounts to income summary by debiting the revenue accounts and crediting the income summary. We will bring accounts with credit balances to 0 by debiting them. Secondly, second entry, close debit balances in the expense accounts to income summary by crediting them and debiting the income summary. We bring expense account debit balance to 0 by crediting them. With a balance of 0, revenues and expense accounts are ready to accumulate a record of expenses for the next period. Entry 3. Close the income summary to retained earnings. After steps 1 and 2, the balances of the income summary is equal to the period's net income. This third closing entry transfers the balance of the income summary account to the retained earnings account. The entry closes the income summary account. The income summary account has a 0 balance after posting this entry. It continues to have a 0 balance until the closing process again occurs at the end of the next period. If a net loss occurs because expenses exceed revenues, the third entry is reversed, debit retained earnings, and credit income summary. Now, step 4 is to close the dividend account to retained earnings by debiting retained earnings and crediting dividends. This entry gives the dividends account a 0 balance, and the account is now ready to accumulate next period's dividends. Let's see how this process works using an example. And to prevent confusion when you try to make closing entry, it's an excellent idea to follow these 4 steps exactly. Okay? To illustrate the closing process, we'll go back to the simple T account. T accounts allow us to illustrate both the form of the closing journal entries and the impact on the general ledger, okay? You still need to actually write out closing journal entries on another page in the journal and then subsequently post them to the general ledger. You will be doing this in your accounting cycle problem number 3. Moving on to our example, let's assume the company only has 1 expense account and 1 revenue account, and that the beginning balance in retained earnings is $7,000. We'll see this a little later, dividends of $2,000 have been paid. At this point, we can prepare the entries to close the revenues and expenses. So do you know what those entries are? Well, let's take a look at the T accounts to close revenues and expenses. You should have the following entries. To close revenue, we debit for $25,000 and credit income summary for the same amount. To close salaries expense, we credit it for $18,100 and debit income summary. again for the same amount. After closing revenues and expenses, their balances are zero, and we can see that the balance in the income summary account is $6,900. This is actually the amount of net income for the year and must be transferred to the retained earnings account. So what is the entry to close income summary to retained earnings? Well, since income summary has a credit balance, we will zero it out with a debit while crediting retained earnings for $6,900. Notice that the retained earnings account has just increased by the amount of net income for the year, $6,900. Okay? This is an important concept because it should remind you of what amounts show up on the statement of retained earnings. Also notice that the balance in the income summary account now is zero. Our last closing entry involves retained earnings. Now, dividends, to be clear. Because dividends always carry a debit balance, we close the dividends account with a credit and debit the retained earnings account for the $2,000. Okay? The balance in the dividends account is now zero, and you can see that retained earnings is being reduced by dividends. So let's determine the balance in retained earnings after all closing entries have been made. After closing, the retained earnings account has a balance of $11,900. We arrive at this amount by adding together the beginning balance in the account plus net income for the period, $6,900, and subtracting dividends paid of $2,000. Should look like the statement of retained earnings. Once the closing entries have been recorded then in the general ledger, the updated balance in the retained earnings account will be $11,900. We have now finished the closing process with the exception of our last trial balance, the post-closing trial balance, and then we will be ready to start the next accounting period. After closing entries have been posted, the next step is to prepare the post-closing or after-closing trial balance. Can you believe it? Another trial balance? There are 3 different versions that accountants create to reflect the different steps of the accounting cycle. Oh my. The purpose of this particular trial balance is to verify that all the temporary accounts have been properly closed out and that the accounts are still in balance. The trial balance account now for retained earnings now reflects the closing entries too. Okay, and the only accounts on this trial balance should be the balance sheet accounts. When you glance at the post-closing trial balance, you can tell whether it's been properly closed if the only accounts that are listed are the permanent or real accounts, and they include asset, liabilities, and equity accounts. Retained earnings, again, should now be equal to the amount reported in the statement of retained earnings. Congratulations, you've completed all the steps in the accounting cycle during your work in chapters 2 and 3. It's a great job. So this concludes the second part of chapter 3 with one more video to go. What a relief, huh? Next, then, we will cover the classified balance sheet and 2 liquidity ratios.